Hello and welcome to this equity market update from Invesco Mutual Fund. This week was historic with the Indian equity indices scaling a new high and the Nifty touching a level of 10,000. So while the equity markets in India have done exceedingly well in the space of the last 12 to 18 months time, questions are being raised on whether the markets are justified at current levels and how should investors, prospective as well as existing, approach the markets from here on. In the past 2-3 years, India has been a tale of two contradictions. So while it has been faced with a slowing economic growth cycle resulting out of a weak private investment cycle, slowing urban and rural demand, and even a weak credit cycle, it has enjoyed great macroeconomic stability on the other hand. Most of its economic parameters, interest rates, inflation, currency, twin account deficits have all been in great shape as never before. Moreover, India is probably headed towards its second good back to back monsoon in many years, which raises the prospects of improving rural demand. Besides, in many other parts of the world, we are seeing a global cyclical recovery after a very long period post the global financial crisis. We therefore believe that the economic growth cycle in India is also set to reverse, and corporate sector earnings growth, which has been elusive for a good number of years, is now on the anvil. We believe this corporate sector earnings growth has merely been delayed but not destroyed. India has also been in a happy situation to have a very strong political formation, which has undertaken several sweeping reforms in the space of the last 2-3 years. Some of the more recent reforms, like GST and demonetization, have probably hurt the economy in the short term and have been some stumbling blocks. But we believe that these structural reforms are likely to bring in significant benefits to the Indian economy in the coming years. And that is the reason why we think that India is at the start of a multi-year growth cycle. So even as headline valuations appear expensive near term, we think the markets are not as demanding. If one were to probably believe in the promise and prospects of significant acceleration in earnings growth over the next 3 to 4 years' time. However, in view of the fact that the markets have rallied pretty sharply in a very short period of time, markets are up nearly about 22% since the start of this calendar year itself, modest corrections along the way cannot be ruled out. We would think that these are part of a healthy bull market. In fact, it was Peter Lynch who once said that a lot more money has been lost in anticipating and timing corrections than in the correction itself. We think India is still at the beginning and in the early stages of its wealth creation journey, and therefore equity investors in India, both prospective as well as existing, would be well served to take a far more longer term view of things in India over the next 5 to 7 years perhaps, and not just focus of what's likely to happen over the next 1 to 2 years time. So while the markets have crossed an important numerical milestone, we think investors should busy themselves more in terms of planning things such as what should be their equity allocation, what are the kind of equity investment vehicles that they should be using, how can they put powerful tools such as systematic investment plans to work for themselves rather than bother as much about the absolute levels of the market. Thank you very much for listening and happy investing.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.